Welcome back to the deep dive. Today we're sifting through the data, distilling crucial insights for you on a topic that might seem, well, a bit complex at first.
Hmm.
The Q1 FY26 financials of ICICI Lombard General Insurance.
Right.
You've shared a stack of illuminating documents, and our mission, as always, is to extract the most important nuggets of knowledge for you.
Absolutely. And this deep dive, it really gives us a fantastic chance to understand not just the raw numbers, but the strategy behind them. The choices they're making, the market dynamics, especially for such a major player in India's general insurance sector. What's really interesting is seeing how they navigate these big industry shifts and, frankly, some pretty intense competition.
Okay, let's dive in then. We'll kick things off with the overall performance and maybe zoom into specific business segments.
Sounds good.
We should also touch on their operational strategies, because some of that looks quite intriguing. And finally, kind of put it all in the broader Indian insurance context. Hopefully uncover some aha moments for you.
Let's do it.
So to start, the headline numbers. For the quarter ending June 30, 2025, what do these results tell us about ICICI Lombard's overall financial health?
Well, the company reported some pretty striking growth. Profit after tax, or PAT, grew 28.7%. Hitting 7.47 billion.
Okay.
And profit before tax, PBT, that was up 28.4% to 9.94 billion. This is compared to Q1 last year, of course.
That's quite significant growth.
It is. It's not just a big number. It really signals, a strong underlying business model, efficient operations, especially when you consider how competitive this market is. Profitability isn't easy here.
Right.
And this also translates into a healthy return on average equity, ROAE. That's 20.5% for the quarter, up from 19.1% last year.
And solvency, how are they looking there?
Very strong. Their solvency ratio is 2.70 times. The regulatory minimum is 1.50 times, so they're well above that.
Okay, so quite a buffer.
Exactly. It's not just a sign of financial health. It gives them flexibility, to navigate market ups and downs, underwrite bigger risk, maybe even look at strategic growth, sets them apart from players with less capital.
Now, let's talk premium income.
Yeah.
The gross direct premium income, GDPI, that grew by just 0.6% to 77.35 billion. That seems low compared to the profit growth. Is there something specific going on there?
Yes. Absolutely. This is a really pivotal detail, actually. Since October 1st, 2024, the regulator, IRDAI, brought in this new 1N accounting norm.
Okay, the one norm.
Right. It's for long-term products. And it basically means premiums are now recognized, spread out over the policy duration instead of all upfront like before.
I see.
So this accounting change, it really impacts how things look compared to previous periods. You can't just compare the numbers directly.
So beyond the technical accounting, what's the practical impact? How do we understand their real growth then?
Well, it means that without adjusting for this, their growth looks artificially low. It sort of masks a healthier underlying performance. If you normalize for this 1N rule, their actual GDPI growth for Q1 FY26 was 4.8%.
4.8% adjusted. Okay, that makes more sense.
Yeah. It's really crucial to keep that context in mind, especially when you compare them to the rest of the industry.
So how does that adjusted 4.8% stack up against the broader general insurance industry in India then?
Good question. The industry's GDPI grew by 8.8% in the quarter.
Okay.
Or, if you exclude that same 1N accounting impact to compare apples to apples, the industry grew by 12.8%.
12.8%. Wow. So ICICI Lombard's 4.8%, even adjusted, is still trailing the industry average quite a bit on the top line.
It is, yes. But, and this seems to be key for them, their strategic focus remains squarely on profitable growth, not just growth for growth's sake.
Right, profitability. How do we measure that?
The key metric is the combined ratio, or CORE. Theirs was 102.9% for Q1 FY26.
Over 100%.
Yeah.
So they're paying out slightly more than they're taking in premiums.
Yes, technically. 102.9 means for every 100 rupees in premium, they paid out 102.9 in claims and expenses. It's a slight increase from 102.3% last year. But, and this is important, it still reflects strong underwriting discipline, especially when you look at the overall industry combined ratio that worsened to 112.6% for the full year FY25.
Okay, so in context, 102.9 looks much better. They're being more selective about the risks they take on.
Precisely. They seem to be prioritizing profitability over just chasing market share volume.
But is there risk there? In an industry where scale often matters, could trailing market growth hurt them long term?
That's the million-dollar question, isn't it? It's clearly a conscious choice they've made. Look at this. Their contribution to the entire industry's underwriting losses was only 2.7% last year, FY25.
Only 2.7% of the losses.
Right, despite having an 8.7% market share. So that really underscores the strategy, quality over sheer volume. They seem to believe that leads to more sustainable value in the long run.
Okay, interesting strategy. Let's talk about motor insurance now. That's always a huge slice of the pie for general insurers. What's the story here for ICICI Lombard?
Right, motor. Their GDPI in this segment grew by 3.2% in Q1 FY26, reaching about $24.44 billion.
3.2%, and the industry.
The industry grew faster at 8.7%. Despite the slower growth, ICICI Lombard still holds a leadership position with a 10.5% market share in motor.
Okay, still number one then. Any shifts within their motor portfolio?
Yeah, a slight shift. Private cars and two-wheelers increased their share of the mix, while commercial vehicles saw a decrease.
Why the slower growth overall, and especially that dip in commercial vehicles? Is that another deliberate choice, like you mentioned?
It seems so. Management explicitly stated it's a conscious call. They pointed to elevated competitive intensity and pricing pressure in the market.
So competitors are pricing aggressively.
Apparently. So ICICI Lombard is focusing on, and I'm quoting here, granular portfolio segmentation and distribution expansion and making prudent selections, especially in commercial vehicles.
Prudent selections, meaning they're letting some business go if the price isn't right.
That's the implication. They want profitable growth, not just volume. It's a bold move when others are chasing volume. It raises that question again, doesn't it? How long can competitors sustain aggressive pricing if it leads to big losses?
It does. It feels like a waiting game almost. Now, any whispers about a motor third party or TP price hike, that's the mandatory bit.
It is. The industry has made representations to the regulator asking for a hike. There's no official update yet, but it's kind of expected, as they put it.
Why expected?
Well, TP pricing hasn't really changed for about 4 years. And meanwhile, you've got rising court compensation awards and general claim inflation. So the industry feels a hike is warranted.
Makes sense. Okay, moving on. Health insurance. Such a critical area. Growing fast in India. How did ICICI Lombard perform here?
Right, health. The overall health segment GDPI grew by 1.9% to $23.81 billion. Again, that's against an industry growth of 8.1%.
Slower again. But wait, is there more to the story? Like with the overall GDPI?
Exactly. You have to break it down. The retail health business, the policies sold to individuals, that's the real standout here.
Okay.
It grew by an impressive 32.2%.
32%. Wow. And the industry retail health growth was?
Just 9.4%. So ICICI Lombard significantly outperformed there. And this boosted their retail health market share quite a bit, from 2.9% up to 3.5%. That's a substantial gain.
That really is a significant gain in retail. Very impressive.
Yeah.
But I did notice the retail health loss ratio ticked up slightly. Does that, temper the excitement a bit?
Good catch. Yes, the retail indemnity loss ratio for Q1 FY26 was 74.3%, up from 72.5% the previous year.
Why the increase?
Management attributed it to a slight increase in incidences.
Yeah.
Just more claims happening, basically. However, they do expect the full-year retail loss ratio to stay within their target range, which is 65–70%.
Ow, if it's starting higher.
They believe the continued strong growth in new business, bringing in fresh premium, will help balance it out over the year.
Okay. And what about group health? Policies for companies?
That actually saw a 2.5% decrease in premium. They said it was mainly due to muted credit disbursements in the economy and also that one accounting norm affecting comparability.
Right, the one and again.
But the good news there was the loss ratio actually improved. It came down to 95.7% from 97.9%. So better profitability in group health, even with lower premiums.
Interesting dynamics. Okay, what about other segments like commercial lines, fire, marine, engineering, and crop insurance?
Right, the property and casualty segment. That includes fire, marine, engineering, liability.
Yeah.
It grew by 6.8% to $26.77 billion. The industry growth year was higher at 13%.
So again, trailing the industry. Any specific reasons? Pricing?
Yeah, seems like it. While the overall industry saw some pricing improvements, management noted different levels of price action within subcategories. Basically, it wasn't uniform, so they maintained their focus on profitable underwriting, meaning they likely walked away from some business again.
Consistent strategy then?
It seems so. They do remain market leaders in specific areas like engineering and marine cargo, though. As for crop insurance, Q1 is usually a low season. The premium was tiny, just $0.18 billion.
But they're still active in crop.
Oh, yes. They mentioned winning 3 new clusters in Maharashtra for the upcoming FY26 season. Most of the big bidding opportunities for crop insurance happen later, typically in the next financial year.
Got it. So Stepping back from the individual segments,
Yeah.
beyond just the numbers, what are the underlying strengths, the pillars maybe, that let ICICI Lombard navigate this complex market?
They identify several core strengths themselves. Things like consistent market leadership in key areas, having a really comprehensive and diverse product portfolio, motor health, crop, fire, PA, marine, engineering, liability, the works. Then there's their multi-channel distribution network. They mentioned over 143,000 individual agents, which is huge, plus bancassurance, digital channels, et cetera.
Distribution's key.
Absolutely. They also highlight their focus on customer service and technology. We can talk more about that. And of course, robust risk management and capital conservation, which supports that high solvency ratio we discussed.
Okay, let's pick up on that technology piece. That sounds really interesting. How exactly are they using tech and digital channels to get an edge? Because everyone says they're doing digital transformation.
Right. But here it seems quite concrete. Their main customer app, IL Take Care, has apparently surpassed 16.6 million downloads.
16 million, that's a lot.
It is. And it even has this feature they call an industry first, a face scan for wellness.
Face scan for wellness, how does that work?
It's described as an innovative biometric tool, basically designed to give users a quick, non-invasive health assessment using their phone camera. It's quite futuristic.
Definitely sounds innovative. What else on the tech front?
Well, they're heavily using AI and machine learning. For instance, 67.5% of cashless authorizations in group health are now automated using AML.
Automating approvals.
Yeah.
That must speed things up.
You'd think so. And almost all policies, 99.7%, are issued electronically now. Plus, digital service engagement customers interacting via apps, bots, website has jumped to 38%. That's up from 22% just a year ago. They credit AI, voice bots, and targeted digital campaigns for that lift.
That shift to digital servicing is significant. It must also apply to claims processing, right?
Yeah.
Which is often, the moment of truth for an insurer.
Absolutely. And the scale is impressive. They processed 1 million claims just in Q1 FY26.
1 million claims in 1 quarter.
Yeah, it's a huge operational feat. And they mentioned that nearly 75%, 74.6%, of non-OEM motor claims, that's repairs outside the manufacturer's network, were serviced through their own preferred partner garages. Suggests efficiency there.
And for health claims, any specific initiatives?
Yes, they highlighted their IL Sahayak initiative. It launched in April 2024, and it's designed to assist health insurance customers during their claim journey. In Q1 FY26, it assisted over 28,000 customers.
28,000. How does that compare?
It's a huge jump from the 8,000 assisted in Q1 last year, so they're scaling that up significantly. And this focus on customer experience seems to be paying off. They reported Net Promoter Scores, NPS, of 68 for health claims and 69 for motor claims in FY25.
Those NPS scores are pretty good, right, for insurance?
Yes, generally considered quite strong. For listeners, NPS measures customer loyalty, how likely someone is to recommend the company. Higher scores are definitely better. And just circling back quickly to risk management, they really emphasize their conservative approach, tight internal rules on how much risk they take on. A very high proportion of their investments, nearly 87%, are in super safe government bonds or AAA-rated securities.
Makes sense for an insurer.
And they proudly state they've had 0 defaults on their investments since they started the company. They're also focusing on sustainability, ESG stuff. They have a board-approved climate risk framework and report according to TCFD standards.
Okay, quite comprehensive. Let's pull back now and look at the bigger picture. General insurance in India overall, what does the market look like? What's the potential here?
Well, India is already the second largest non-life insurance market in emerging Asia and 15th largest globally as of 2024. But the key word is underpenetrated.
Meaning there's lots of room to grow.
Exactly. Non-life insurance penetration in India is only about 1/4 of the global average. So the total addressable market is massive, huge growth potential. Plus, the industry operates on a cash before cover basis.
Premiums paid up front.
Right, which provides strong, predictable cash flow. A nice advantage.
Now, we've touched on it a few times, but this competitive intensity, it seems to be a major theme. What's really driving it, and how is the industry coping, especially with these new expensive management or EOM regulations coming in?
Yeah, the competition is definitely high. You see it reflected in that elevated industry combined ratio we mentioned. Players seem to be aggressively chasing market share, maybe sometimes at the expense of profit.
And the EOM rules, how do they fit in?
The regulator IRDAI has set a glide path for these EOM limits. They want companies to bring their expense ratios down to around 30-35% by FY27.
And are companies managing that?
Well, apparently about half the industry, 50% of companies, are still not within those limits. They have to submit quarterly roadmaps showing how they'll get there.
So pressure to cut costs or
Yeah.
grow premiums faster to dilute fixed costs.
Exactly. And that raises the question again, can companies sustain losses just by chasing business aggressively, perhaps partly to meet these EOM targets? ICICI Lombard's management seems skeptical. They noted they're willing to wait it out when competition gets irrational
Oh,
because they believe sustained losses just aren't viable long term for anyone. Switching gears slightly, the macroeconomic backdrop in India looks pretty positive, doesn't it?
generally, yes.
GDP growth was strong, 7.4% in Q4 FY25, 6.5% for the full year. Things like GST collections, infrastructure activity, they all point to positive momentum.
And the RBI cut rates recently, too.
Right, a 50 basis point repo rate cut. Plus some income tax incentives, inflation seems relatively benign, all expected to boost the economy. And a normal monsoon is forecast, which usually helps rural demand.
So good signs for business activity, which should help commercial lines and motor insurance.
That's the expectation, yes.
Yeah.
Of course, there's always the caveat about geopolitical risks impacting global and Indian growth. That's a standard disclaimer these days.
True. Now, speaking of risks and managing unexpected events, you mentioned their strong risk management. There was a tragic event recently, the Air India plane crash. How does a company like ICICI Lombard handle the financial impact of something like that? A major, sudden claim event.
Yeah, management addressed this. They expressed condolences, of course, and said the company responded very quickly to support the affected families. Critically, from a financial perspective, they emphasize that the estimated impact of those claims has been completely provided for within these Q1 results.
So they've already accounted for the expected losses.
Yes. They stress they are well equipped financially to absorb such losses thanks to their strong capital position and reserving practices. It underscores that resilience factor.
Okay. So let's try to wrap this up. We've covered a lot of ground. What does this all mean for you, our listener?
Well, I think we've seen a company, ICICI Lombard, that despite facing some real headwinds, intense competition, new accounting rules, slightly obscuring growth, is sticking to its guns.
Prioritizing profitable growth, you mean?
Exactly, and really leveraging technology, not just talking about it, but using it quite effectively to boost efficiency and improve the customer experience.
Yeah, the digital strides seem quite real.
I think this deep dive really illustrates how those strategic choices, focusing on underwriting discipline, making smart digital investments, managing risk prudently, how those things can differentiate a company. Even in a tough market, it's that classic balancing act, isn't it? Market share ambition versus sustainable profitability.
It truly is. And it leaves us and you with a thought to ponder. In this dynamic, expanding Indian general insurance market, where will the next big aha moment come from? Will it be some kind of groundbreaking product innovation nobody's thought of yet? Or maybe a complete shakeup in how insurance is distributed? Or perhaps we'll see a more fundamental shift in the market dynamics themselves, maybe driven by regulation or consolidation. Something to think about.
Definitely food for thought.
Thank you for joining us on this deep dive. We hope it's given you a valuable shortcut to being well informed.